Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week we're training our lens right here on the United Kingdom. On the 4th of July, the country goes to the polls in a hotly anticipated general election. Whilst the vote was on the cards, the timing caught some observers perhaps a little by surprise. With manifestos being published and the usual media circus in close to full flow, we thought it would be instructive to take a look at some of the key areas in economic terms before the decisive day at the ballot boxes. So today we'll get a bit of a broad macro overview and then take a deeper dive into some specific sectors to hear how the timing of the vote and, more importantly, the direction of political travel post-July 4th might shape the landscape or even the prevailing narrative. Joining us today, we have Anna Titareva, European and UK economist at UBS, Jason Napier, Head of Financials Equity Research in Europe for UBS, and Zachary, who works in the European Rights Equity Research team covering UK-listed real estate companies. Let's start with that macro overview, courtesy of Anna Titareva. Anna, always great to get your insights on the programme. A pleasure to talk to you this time with an eye towards the UK elections, obviously, coming up this summer. Just set the scene a little bit for us, Anna. I guess big picture, in macro terms, what do we anticipate in terms of the impact of calling an election? I guess before we start talking about, what's the cutting cycle going to be, just give us a sense of what the macro impact of these kinds of elections typically looks like.
Yes, thank you. So in terms of sort of imminent impact, I think we should expect a fairly limited impact. We still think that broader macro factors will be at play. Just to put it into context, in general, we expect that after a very strong start of the year where we saw Q1 GDP expanding 0.6% quarter on quarter, we expect somewhat more moderate growth rates in the next couple of quarters and then a bit stronger reacceleration towards the end of the year, with crucially a recovery in household consumption, given that nominal wage growth remains strong and headline inflation has declined quite substantially. We expect that should lead to recovery in real incomes and therefore boost household consumption. So overall, we think that this should be the key driver of growth this year. Now, putting this into context with the upcoming general election, I would say that the key uncertainty and potentially risk from the election is around the fiscal outlook, given already quite challenging outlook for the public finances and the fact that, for example, at the last fiscal event, the OBR estimated fiscal headroom was already very narrow. Of course, the outcome of the election will matter for fiscal situation in the UK going forward. But we have flagged that we think that risks of any sort of market upsets or any big fiscal giveaways in the near term appear fairly limited, not least because of already very tight fiscal headrooms and essentially the fact that the space for this fiscal giveaways is quite limited. So overall, we think that growth will be driven most likely this year by a recovery in household consumption. Concerns around fiscal outlook will still remain relevant, but probably towards the end of the year and more going into the next year.
It's interesting, Anna, because one thing I was going to ask you about is the degree to which there are sort of political considerations here. There's various sort of truisms, the market's like a Conservative win or whatever. We have them on both sides of the pond. It's the same sort of thing, isn't it, with the GOP and the Democrats in the US. But does that actually play a part of your thinking? Is there a degree to which you need to drill down into manifesto commitments from the parties, or actually is the picture largely set, regardless of the political stripes, by the macro backdrop that you've already described?
Well, manifestos are always interesting from the economist perspective in terms of the details. But in general, I would make 2 points. First, if we look at the election polls, they've been quite clear for some time. So in terms of the outcome of the election, the market has pretty much fully priced in what the opinion polls are suggesting, the very strong lead by the Labour Party. So potentially no upsets from the market perspective if we do end up with with this outcome. The second point is also that, as I mentioned earlier, the key uncertainty and potentially the key risk is around fiscal outlook. And of course, potentially new Labour government would imply bigger spending pledges and therefore further risks around the fiscal outlook. Having said that, if we look back, at the last few months, we've seen two changes from the Labour Party. First is the strong commitment to fiscal prudence. We've seen that a Shadow Chancellor has committed that any fiscal event that will be held in the future will be accompanied by the OBR projections and OBR assessment. So there seems to be a commitment to make sure that the mini budget episode is not repeated. And secondly, also when it comes to the big spending pledges that were previously announced by the Labour Party, especially around the green energy, the energy transition, we've seen some backtracking by the Labour Party in recent months. Again, this is sort of an acknowledgement of very challenging situation in terms of public finances. So again, taking this all together, it seems that the scope for market upsets and market surprises is fairly limited at this point.
Well, just before we bring Jason Napier in to talk about banking, let's just look at the central bank picture just very briefly. Anna, it's still one of the key narratives, isn't it? Pace and rate of rates cuts. I don't know, how does that play in? And again, does the calling of an election, a surprise election really, does that really change the landscape in those terms, do you think?
So we've said that in terms of the election itself, we don't think that it affects sort of the speed of the rate cutting cycle from the Bank of England. We still think that the macro data, especially around services inflation, around wage growth, is going to be crucial for the Bank of England's policy decisions. However, we did change our call in terms of the timing of the first rate cut by the Bank of England. We pushed out the call for the first rate cut from June to August. Now, predominantly, this decision was driven by the fact that the data, especially on inflation, has been disappointing between now and the previous MPC meeting in May. But we also did acknowledge that the fact that the next election will take place in July and the next MPC meeting in June, and the fact that the Bank of England has cancelled all public appearances and speeches in the run-up to the election also suggests a somewhat cautious approach of the bank in this regard. So overall, we think that policy decisions will remain driven by the data, and we expect the first rate cut to take place in August.
Yeah, fascinating, Anna. Thanks for sharing your insights. Jason Napier, let me bring you in here, because I think one of the other really interesting things is to look sector by sector, and whether we're looking at real estate, which we might do in a moment, or telecoms, always so interesting. In your case, let's talk about UK banks. Roll the clock back a bit. Announcement of the election. What's the first kind of questions that you and your colleagues, when we're laser focused in on UK banking, what are the first questions you guys are focusing on?
Well, I guess bringing the election forward perhaps 5 or 6 months relative to when it might have taken place may not necessarily change sort of the destination, but sort of the key area of policy uncertainty, which has been a focus for the market in the last couple of months probably, has been around some suggestions that we've heard around the Labour Party and at Reform UK that perhaps the Bank of England ought to change the way that it remunerates banks for cash balances that they hold at the Bank of England. You may be aware that as a consequence of quantitative easing, when the Bank of England, bought £800 billion worth of government debt using borrowing, that swelled the amount of excess liquidity in the system. And at a time when rates were low, the Bank of England made a positive carry on that. There was a net profit for the Bank of England and for the taxpayer as a consequence of that. Of course, when interest rates went higher, that has now swung to a net loss. And so the suggestion has been made, as I said, by at least two of the parties, that what ought to happen, in a similar way to what's actually implemented by the ECB, is that banks receive less of an interest payment for the cash they hold at the Bank of England. And this matters a great deal because the sums involved are large. Quantitative easing in the end was about 32% of GDP. So the numbers are big. And the politics of levying additional, what effectively would be a tax on banks look attractive to many observers. The UK banks already pay a bank levy and they have a corporate tax top-up. But for a government that may be looking to raise additional funds to, fund the NHS or education or many other sort of destinations, it seems to many that banks are an attractive political target. And so that is the most important area of focus for the investors right now, as far as the election outcomes is concerned.
Well, yeah, and I guess, I don't know if it's politically sensitive to get further speculation, Jason, from you, but what's the feeling about whether this comes in or not? As you said, there's a lot of contradictory, as you would expect in something that is quite politically charged, about, look, there's an argument for saving public money, there's an agenda that says we're enhancing central bank independence by pushing some of these levers. What do you think the direction of travel is, or the probability? I guess it is all contingent on the outcome of the vote in July, right?
It is a fascinating situation, for sure. We published a piece of research on it a month or two ago, and the situation is made complex by a number of factors. Firstly, the governor of the central bank, Governor Bailey, has, in testimony to the House of Lords, said that he does not need depositeering or this change in order to pursue the monetary policy objectives that are his job. He has said that he doesn't support a change of this nature. And so some observers would remark that if government were to then go against those publicly held views, that might have consequences for the way people think about central bank independence. And if indeed it is just a tax, if we're looking for additional monies from the banks, the easiest thing to do is to actually levy a tax. Now, the Labour Party have already made an undertaking that corporation tax, VAT, and personal income tax rates will not change. And so it would appear that to some, the virtue of changing the way deposits are remunerated at the Bank of England is simply that it's a tax that isn't called a tax. And so it is a remarkably complex period. We've made the point that a country that has large external borrowing commitments, that is effectively pursuing not only issuance to cover its budget deficit, but is also selling bonds acquired through QE, probably needs to think very carefully before potentially changing views around the independence of the central bank. And so our base case is not that this takes place. We think that for every 1% of deposits that the banks hold at the central bank, if they were to be unremunerated, we're looking at around a £200 million hit per large bank. That works at 2 to 3% of profits. And it will be a number that would probably be recovered, whether people like it or not, largely through lower deposit yields for customers and higher debt costs for borrowers. And so to the extent that it's there to raise taxes that are effectively going to be levied on the market as a whole, we'd rather that it just, was left out of the monetary policy framework, if you like, and was just levied as a tax. It would be far clearer and I think practically far less potentially controversial than the alternative, which is up for discussion.
Jason, perhaps one final thought on the sector for us.
It's well documented that the UK has very poor credit growth at the moment and has done in the wake of, a lot of emergency borrowing that went on around COVID and then the increase in interest rates. So credit growth is low. Investment spend as a proportion of GDP is towards the bottom end of global standards. And so the key thing for investors in the banks is effectively two things. One is revenues in the UK banks will actually grow even as rates fall because of the way that they hedge their interest rate risk. And so revenues will go up even as the economy receives a boost from lower interest rates. And so it's a very, very positive thing for the domestic banking sector. Should we get manageable amounts of rate cuts, stability in policy, and improving tendencies to invest and to borrow. And so the setup for banks in a stable macro environment is actually very good in the UK, but it's that stability and the predictability that I think investors are looking for now.
Jason Napier, thank you very much. Well, let's shine a light on another sector now, which I mentioned a little earlier, and that's real estate. Let me bring in Zachary Gage, who works in the European Rights Equity Research Team covering UK-listed real estate companies. Just to kick off then, Zach, tell me about the narrative for you and your colleagues, looking at this sector when that snap election was announced. Obviously, just the timing of it took a couple of people by surprise, especially some of the sort of Westminster watchers, etc. But what was the first topic that you and your colleagues get stuck into? Because I guess things like interest rates and the direction of travel regarding those are they're kind of apolitical in a way. But tell me, what was the first topic when the date was set?
I mean, to be completely honest, the reaction was relatively muted. I think people knew there was going to be an election within a time frame. Yes, it probably came a little bit quicker than expected, but given where polling is and what had already been announced, we certainly didn't suddenly have a flood of calls asking what's the impact going to be. I think most people have looked at this for some time and assumed that there will be a change of government at some point in the next 6 months. So it's not something that, it being called slightly earlier than expected, has really moved the needle. Obviously, as we go through the process and we start to hear a little bit more about what would be entailed should we have that change of government, then some of the sort of more specific policies that could impact real estate start to come out, and that kind of starts to lead the conversation rather than the timing and the fact that it's happening.
Yeah, absolutely. And we'll talk maybe a little bit more about the potential reshaping of that narrative, infrastructure plans, for example, in a second. But just on rates, I guess. I mean, that is the key thing, really. That's what stocks are most sensitive to, isn't it? Interest rates. Worth just, I guess, checking in. Where are we at in that process, in your view?
Yeah, I mean, you'll have already heard Anna's view, and that's, broadly something that we follow. I don't think they're anticipating a major change in the pace or the direction of cuts as a result of the election. And as I say, given the likelihood of a change of government, markets have largely priced in any impact that would come from that. I know that they did move back the date of the first rate cut in the UK from June to August, but those sort of types of incremental movements tend to not have a huge impact on the UK property sector. It's more the long-term expectations for interest rates, in particular government bond yields, that investors tend to benchmark property returns off. So thinking about how that could change in the future, I mean, obviously very traditional thinking would suggest that a Labour government might be higher borrowing and higher spending, and intuitively that would lead to potentially higher long-term rates. But given the leadership of the Labour government and the relatively modest stance and the clear intention to maintain a strong level of fiscal discipline, I don't think investors are, certainly the investors we're speaking to, aren't particularly worried that we're going to potentially have a Labour government and then a surge in spending and borrowing that's going to push up the cost of UK borrowing.
Yeah, well, let's talk a little bit about potential infrastructure plans. And obviously, this is somewhat difficult. You're not in possession of a crystal ball. And I guess between now and July 4, we're going to get more detail from all the various protagonists about specifics of their plans. But maybe give us a sense of, I don't know, what the market would like to see, or when you have those conversations with clients in terms of areas of interest, in terms of what a new direction of travel might be in terms of building plans and so forth. Are there some key things at least to look out for?
I think, first of all, it's probably important to split out the commercial real estate side and the residential real estate side. So commercial is predominantly what the listed REITs that we cover are invested in. There is some residential exposure, and there's a couple of REITs that are specifically invested in residential to let property. But I think it's probably best we handle them separately, because obviously residential home building is sort of a separate topic and is generally much more political than the commercial side. So starting with the commercial side, ultimately what over the long term drives commercial property performance is growth, and it's growth in the sector that the commercial real estate is situated. If you don't have growth in demand, you don't get occupancy and you don't get rental growth. It's relatively extremely highly correlated over a long period. So most of the conversation we're having are actually more around that macro piece, that is the government going to be favourable to growth and to the sectors that commercial real estate REITs are generally focused on. And a few components really sort of feed into that. One is having a clear direction on policy that's very critical. Another is around migration and the ability of companies to hire the right staff, and for cities, in particular London, to continue to be able to attract global staff and talent. That's obviously particularly relevant for the office sector. And taxation is another critical part. So the UK historically and still is seen as one of the most friendly investment environments for overseas investors to invest in commercial property. And that obviously benefits the market by providing liquidity, and ultimately when there's a lot of capital coming in, supporting value appreciation. Now, of course, there's been some question marks around a potential capital gains increase under a Labour government. That's probably the biggest single piece of potential legislation change that would have a direct impact on the sector. But really, aside from the more sort of specifics around the investment side, what investors are looking for is a government that can deliver long-term growth that's accommodative to business requirements and is open to allowing a certain degree of immigration to support the growth of businesses and maintain UK cities as attractive destinations for people to run and grow their businesses. On the residential side, again, it's more influenced by the need to provide a certain number of housing stock for people to live in. Some of the big questions that people would have had, and I know this has been sort of answered, is whether there will be some form of rent control introduced. This has happened in most other parts of Europe, and generally the results are that people stop building because you simply can't get the returns to stack up, particularly in the current environment of higher interest rates and much higher build costs. So generally where these have been implemented, and you could take Dublin as one example, the impact has been a much more severe shortage of housing because it just doesn't make sense to develop. So I think the sector as a whole has seen it as a very positive sign that Labour came out very early and said that they won't be introducing specific rent controls. And this is not about landlords wanting to move rents up by astronomical levels. Particularly on the institutional side, you're looking for residential to provide largely an inflation hedge, so rents moving up in line with inflation or wage growth. People generally aren't looking for excessive rental growth, despite what some parts of the media might portray. And ultimately, if you put penal rent caps on that mean that they're not able to achieve that, then, as I say, the investment proposition just doesn't stack up and people don't develop it. So that's probably been the key indicator on policy, at least, that we've had on the residential side.
Was that, you mentioned capital gains? Just tell me a bit more about that, because that is very much one of the hot topics, isn't it, in this space? What sort of further impact of that potentially as you see it?
Yeah, so for my coverage, so for the listed real estate companies, the direct impact is probably less significant. So REITs are obviously set up to be a tax effective structure to prevent both the company and then the owner of the shares being taxed twice. So UK REITs are exempt from paying capital gains on development as long as they hold the asset for 3 years after completion, which obviously in the majority of cases they do to avoid that tax bill. Only very rarely would they sell if it turns out that they haven't made any significant profit from the development. So the direct implication for them would be less limited. Where I think this does have a much bigger impact is on the wider market. Now, the UK is recovering fairly well from the correction and compared to global peers, but certainly one of the aspects of the UK commercial property that particularly overseas investors like is having a relatively stable and favourable tax regime. And clearly, if they were to find that the capital gains they would pay when selling any UK property that they purchased has increased, does diminish the UK's attractiveness in a global context. And I think potentially the biggest challenge, and this is something that they will need to think carefully about, is capital gains tax intuitively hits development harder, because anyone who's developing typically is generating more gains through the profit that they generate from the development that they undertake. And you certainly don't want to create a position where development becomes less attractive and the UK becomes a less attractive market to develop in. I think everyone recognises the need to upgrade the quality of our commercial real estate. There's a lot of sustainability requirements that are coming into play. That all requires investment, and that investment is going to be less willing to come if it feels like it's going to be heavily penalised if it's successful. And then when they sell, they get hit with a higher tax bill. And obviously, the one thing that really damages commercial real estate activity is uncertainty. So even if this is something where the door's left open to, an investor buying in would want to know, give or take, what their exit tax rate is going to be so they can underwrite the investment properly. If there's a period where they think it's going to be 28% and then actually there's a fear that it could increase over the holding period, well, that then makes it a much riskier proposition and they're less likely to do it. And certainly in terms of their desire to hit residential targets, again, there's no doubt that the UK needs a lot more housing to be built. I think a lot of that can come from the build to rent sector that institutional buyers can invest into. But again, if they're potentially going to be hit by a much higher capital gains tax bill at the end, that does decrease the attractiveness of it. So it's just something that I think needs to be clearly communicated and handled relatively carefully to not put off some of the development that I think parts of the market still need to see.
Zachary Gage, and before that, Jason Napier and Anna Titareva. And that brings us to the end of this edition of the Bulletin with UBS here on Monocle Radio. Listen again and explore more at monocle.com or follow the programme wherever you get your podcasts. As always, you can discover more and find out how UBS can help you by heading over to ubs.com. I'm Tom Edwards. Thanks for listening.